But yeah, my name is Rob Price. Background in economics and investment management, pension fund management, and yeah, I guess basically, I mean, I've been looking at a number of these subjects for many years, and I guess I've just come to the realization in 2020 that sound money is the challenge and opportunity, I think, of our lifetime. But I mean, certainly over the next 5 to 10 years, obviously this is all my opinion, and I guess that comes onto the second point is that, I mean, of course, this is all just my opinion. This is not, investment advice or anything like that. If I'm not making any specific investment recommendations to anybody, but these are just ideas that are very close to my heart and really where I'm focusing my energy at the moment. And yeah, wanted to share those ideas with people within my network. I think they're that important and that valuable. And yeah, as I said, I'm investing my time and my capital, along these lines to make both kind of intellectual and financial gains. And as I said, it's important for me to share those with the rest of the people in my community. Yeah, so please do. As I said, I do want to make it reasonably interactive, but I'll leave a lot of time for questions at the end. I'm going to keep the presentation to under an hour, and then stay on for questions thereafter. Please please write your name and kind of where you're from in the chat, just to kind of just see who else is on the call. And you're welcome at any time to just write a question on the chat, and just let people know what you're thinking. A lot of these subjects are difficult to get our head around, but it's through thinking about them, also admitting what we don't know, that we start to get a grips on what's going on. And yeah, I just really hope that it's useful and valuable for you. So the more questions that you ask, I think the more valuable it will be for you. And I mean, I guess I've touched on this already, but for me, I mean, it's all about this purpose. I really do want to live in a world of sound money or sounder money, and I will explain to you why. And I'm taking actions towards that outcome and assisting individuals and businesses towards financial peace of mind through understanding these ideas, understanding the consequences of the unsound world that we live in, and why we need to take different actions to mitigate against those risks in our life. Yeah, and important for me that I'm focused on investments. That's kind of my background, and there are obviously ideas here that one could use from an investment perspective. As I said, this is not investment advice, but at the end of the day, a lot of it does come down to investment returns. But important for me that the features of kind of what I'm bringing to you as information is not just about investment returns. It's about underlying knowledge. It's about relationships. Relationships with our money, with finance, with economics, and also with people and community. And hence why it is so important, I think, for kind of us to connect with each other, even in this kind of virtual world, to build strong relationships based on sound foundations. And then lastly, also the mindset. I think the world is a very challenging place in many different respects. And of course, I'm biased, but I think a lot of it comes down to the unsoundness of our financial system. And I do believe that through understanding these concepts, we're able to have a much more kind of positive and proactive engagement with people and, just lives in general. So I just wanted to kind of, reiterate here that it's not just about investment returns. There's so much more to this than that. So a brief outline of what I'm going to talk to you about is, of course, sound money. What is it? How did we get here? Or how did we get to an unsound world, and why? And then the consequences. I do think that's really important because it gives the motivation for why am I talking about sound money? It's to understand what the consequences are of this very unsound monetary system that we currently live in. And then a couple of proactive solutions. And as I said, I'm going to leave a lot of time for questions. And I'm going to try and keep the presentation reasonably brief and high level. So I'm going to keep the presentation reasonably brief and high level, so that there's lots of time for questions, and it touches on a few different people's knowledge sets. So please just kind of stick with us and make the most of it. So really starting at the foundation, as I said, I'm going to try and give you a bit of a crash course almost here into economics and monetary economics, but I'm going to keep it very, very short. I mean, yeah, the foundation here, I mean, what is money? The long and the short there is, I mean, money is a good. It's a tool that is actually arises on the market. We almost have to have a brief understanding of monetary history here. That societies used lots of different things for money in the past. People used even things like salt and beads and seashells. In history, and why did they use these? Well, money is basically, as I said, it grows out of the market, and people gravitate towards using some of the most tradable good. But bananas for apples has its limitations, right? What if you want you only got bananas? Then you need to get kind of into the apples to get the shoes. That doesn't really make sense. People gravitate towards some sort of more tradable to use as money. And I kind of a little picture, things that people have used in the past, and it's quite easy for us to critique what is good and what is not good. As I said, fruits and vegetables are not particularly because they'll incredibly. Some people have used seashells, or at least those are a little bit less perishable than vegetables. But different seashells have got different sizes and different qualities, and they might chip, so they're not entirely durable. People have used livestock as well as money. Once again, has some benefits, has some weaknesses. I mean, livestock at least generally does last for a little bit of time. They stay alive, but they also will expire at some point. They're transportable, but not hugely so, not over long distances. So as I said, we can kind of grapple with these different forms of money that the market choose. That the market chose these in different societies depending on kind of what was available and what made sense. And over time, there were revolutions in money, and people gravitated towards metals as being a better form of money. Because they were kind of more durable, they were easy to easy to divide, right? A cow, a problem with a cow is you're trying to do a transaction for half a cow, well, you can't really cut the cow in half, of course. So another limitation. Whereas metals overcame a lot of that. You're able to make smaller quantities of metals. They're easier to transport over longer distances. And gold, which we'll get onto a little bit more later, was often chosen because it is the most scarce of the metals, and was money for many thousands of years. But over time, even gold has weakness. Gold is very durable. It's reasonably easy to store because you can have high quality quantities of value in a. Sorry, I'm just letting another person in here. I thought I'd set that on, but never mind. So gold is. You can store a lot of value in a small amount, so it's quite easy to store. As I said, it's divisible, transportable, but it has its weaknesses because it's not perfectly transportable, right? If you want to transport billions of dollars in gold, well, that's quite a security risk. It's quite heavy. It takes a long time. What if you want to take it goes, it gets the ship gets crashes and lose all that gold. So there were risks, right? And people gravitated towards using almost warehouse receipts. That's how we started with paper money, and we've moved into this world of paper money. So anyway, I just wanted to describe a little bit of the foundation there of what is money. Because I think it's really important, because we often we just think, okay, rands are money, or dollars are money, or euros are money. And in truth, there is a theoretical basis here, which is important to understand. And the desired qualities, basically, of a money are these ones. And as I've said, different monies are good at certain qualities and not good at other qualities. But on the whole, we want a money that is durable, that's divisible, right? We can break it into smaller amounts. It's portable. We can move it. It's immutable. That's the one we might understand a little bit less, but it basically just means that $1 is $1. $1 in LA or Johannesburg or New York are the same thing. So it's immutable. Whereas seashells are not perfectly immutable because they're different. Cows are not perfectly immutable, but a Krugerrand is perfectly immutable because once it's in a Krugerrand form, we know that one Krugerrand is the same as another Krugerrand. And then scarcity, of course, is important, right? If you can just create a lot of money, if you can create a lot of seashells, then it's not so good as a money, because people who are storing their value in those seashells suddenly get a loss of value. And there's been examples of this in the past. That in North Africa, people used beads for many hundreds of years as these scarce beads that were scarce in that region. But as European settlers came in and realized that these societies were using these beads, well, they just found a way to manufacture the beads, bring the beads into North Africa, and suddenly that society, went through a lot of, volatility and a loss of value, because suddenly their money became worthless, due to the, in hindsight, it wasn't a very good form of money, but they didn't realize that because they didn't have the, manufacturing ability to create those beads. So anyway, it's good to appreciate that money has changed over time and it has these various qualities. And as you can see, scarcity is one of those that's important. So getting on to what is unsound money, and I'm obviously making the contention here that we live in a very unsound money world. So unsound money essentially is just a money that has very little scarcity, very little constraints on the amount of that money that can be created. And as I've just given the example to you, that's not a good thing. And it's very easy to see that the world that we live in is that world of unsound money with very few constraints. Here's, one example is US M1 money supply. It's just a definition of US money, the amount of money. And you see how this has grown dramatically over many years. Now, important to note that, money doesn't equal wealth, or money doesn't equal capital. And you, once again, can see that very nicely in this chart, because in 2020, M1 money stock has absolutely ballooned. You can see that graph has almost gone parabolic up to the right-hand side. Now, of course, you know that in 2020, the amount of wealth in America or the world has not dramatically improved. We know that the amount of capital has not dramatically improved. All that's happened is that authorities have used tools and techniques to create a lot of quantity of new money. And so that's a very easy example of how unsound the monetary system is, that the authorities, the policymakers, can so easily increase the quantity of money. And so the money can be created in many different ways, right? And the most common way is through debt, right? If I buy a new car, it's not like the bank actually has the money to give to me to buy that car. They just create a higher balance on a certain account in order to create that capital for you to create to buy the car. And same thing with other debt origination, buying a house or whatever it might be. So when debt increases, the amount of money is increasing. So another easy example to show of just how unsound the world that we live in is looking at debt to GDP. So, the amount of debt that governments hold relative to the size of the economy. And this is across the developed markets here, this orange line. And it just basically shows you that, debt to GDP is, at the highest levels that it has almost ever been in the history of the world, comparable with levels during the Second World War, where, governments were going into lots of debt to fight, wars against each other. So governments have taken on this decision to create a lot of debt. And remember, this is just governments. We're not even talking here about households, about the corporate sector. But it's another example of how unsound the monetary system is that we live in today, where there's no constraint on the amount of new money that is created. And of course, this is not a developed market phenomenon. I've just put in here, I mean, a lot of the listeners here are, from South Africa. This is just looking at South African government debt to GDP, also going, ballistic in recent years, with very little constraint on the amount of new debt that is being created. So, I mean, I'm going to get into the consequences in a moment to tell you why I don't think this is a good thing. But first of all, just kind of like, how did we get here? How did we get to such unsound money? And the long and the short here is that we've overused economic stimulus. So every period of volatility in society, whether it be financial volatility, political volatility, social volatility, what policymakers do is they use the tools at their disposal to try and appease that problem, to try and dampen the volatility. So if they see, as I said, volatility in financial markets, the stock market is falling dramatically, they say to themselves, okay, let's lower interest rates, let's flood those financial markets with new capital to try and dampen the volatility and kind of ease out the problem. Or the economy is not doing so great. Okay, well, let's do the same thing. Let's lower interest rates, let's create money, and let's pump it out into areas of the economy to try and get things going again. Or there's some segment of society that's unhappy, university students who want more capital to pay for their university education. I'm not going to make any political statements here, but once again, government just follows the same policy. They just say, okay, let's appease this problem by creating new debt and appeasing it. So they've overused economic stimulus without consideration of what the consequences are. And of course, they've removed the natural constraint, because normally if interest rates are very high, that constrains your ability to take out new debt, right? And what I'm just showing you here in the graph is that negative relationship between debt, which is what we showed earlier, the debt to GDP across developed markets. The orange line is the same chart that we already looked at, and the negative relationship to interest rates, right? When interest rates are very low, the cost of borrowing is cheap, people take out more debt, whether it be households. Here I'm showing you governments, but same thing for households and the corporate sector. So policymakers have removed these constraints by lowering interest rates repeatedly, encouraging people to take on more debt. And it's a very short-term focused policy. That's why I call it kind of short-termism. Because what they're doing is they're saying, we have a problem, whether it be political, social, financial. Let's just try and paper it over in the short term without considering what the consequences might be. And that gets us into the next point. What are the consequences? And from my perspective, I mean, listen, I think the consequences of these policies are very widespread and they are numerous. I'm just going to touch on a few to try and give you an introduction into the idea. But as I've described to you already, you can almost see it. That short-termism in of itself is a consequence. If we make a nice, easy example, as individuals, when we decide to buy a house, what are we doing? We're saying, I can't afford the house today, but I will mortgage my future income. I'll take all the future earnings that I'm going to earn over the next 10, 20, 30 years, and I'm going to spend it today, and I'm going to forego it in the future because I'm going to pay down that property, right? But what I've done is I've mortgaged my future income to buy the house today. That's just what I've decided to do. And listen, there's important to note there's nothing wrong with using debt. It's obviously an important instrument that people make use of in the economy. But the point that I'm making here is when everybody in society is making use of that implies that we've basically kind of mortgaged our future. We have taken all of that future earnings and we have said, okay, well, let's spend it in the present. And that's obviously been going on for many years. So, it's no surprise then that you eventually reach that future and you realize that some of it has been mortgaged. And as a result, it has an impact on economic prospects. Now, listen, I'm not to say that, the economy is going to crash tomorrow and that there's no prospects out there. Of course, there are prospects out there. There's all sorts of new technologies, new industries that are doing absolutely wonderfully. And I'm not here to be a doomsdayist about this whatsoever. What I'm saying to you is that when you take out all of this debt, it has some consequences. And you can see that in broad economic growth rates. In most countries around the world, they just trend ever so slightly lower. Of course, there's volatility, year to year, quarter to quarter. 2020 was, of course, an incredibly bad year for economic growth. But well before 2020, growth rates were trending ever so, steadily lower. And a major component to this is debt and overuse of debt and debt saturation. And of course, that has consequences on, our interaction with each other as individuals and social mobility. So, we shouldn't be surprised when we see people with greater amounts of frustration in society when so many of these economic prospects have already been kind of used in the past. And then the component that I wanted to describe a little bit more as it speaks to investments is the investment return expectation. And of course, all these subjects are kind of tied in together. But as investors, of course, we are investing our capital, and everybody is investor. Whether you're saving for your retirement, you're saving for a house, you're saving for your child's education. We all conduct investing for our future, and we are investing into assets to provide us with those returns, right? And what unsound money does is it creates a lot of that capital, a lot of that debt rushes into financial markets and has an impact on them. And that's what I'm showing you here in this graph, is that this is the valuation on global equity market indices. The S&P 500 is the US equity market index. The MSCI World is the global equity market index. And you're looking at the market capitalization, which is the amount of money invested into these equity markets relative to the size of the economy. And what they show you is that there's a huge amount of money invested into equity, some sort of financial product, relative to the actual underlying economy in which that equity is investing. Now, that is unsustainable. And what we find is that there's a very strong negative relationship between overvaluation and weak subsequent returns. And of course, vice versa. If there's undervaluation, if there's underinvestment, the subsequent returns tend to be strong thereafter. So at the moment, in 2021, the start of 2021, we're sitting at record high equity valuations across the world. Why? Well, because as I've said, we've low interest rates created all of this debt. This money floods into financial markets, and that implies that the long-term return expectations from these assets is constrained. And when I say long-term, I mean it's not precise, but 5 years, 10 years out, the real return expectations from these assets, which are the primary component of most investment portfolios, is going to be weak. Now, I'm not predicting what's going to happen with equities this year, this month. In the short term, financial markets can continue to move in all sorts of different directions. These relationships don't hold a strong relationship over the next next month, the next quarter. But over the long term, I have a strong conviction that these assets aren't going to provide this type of returns that we want them to, because it's quite clear that they are expensive. And as I said, once again, there's a consequence there from a specific investment perspective, but there's a consequence also from a personal perspective, from a family planning perspective. You're trying to save and invest, for your future, for your retirement, for your children's education, and it's challenging. It's incredibly challenging, and that's a challenge which we obviously need to stand up to and try and solve. But it's another one that is linked to this very unsanitary system which we are contending with. And once again, just making the point here, I mean, sometimes people get lost in the global data. I'm just showing you here the South African data too. Equity market cap of the all share index relative to GDP. It's expensive, so the same factor holds. I have made the point, but reiterate again that the whole global economy is very interlinked. Monetary policies are very interlinked. So almost all governments are conducting these unsound policies of lowering interest rates and overusing debt. Just touching on a little cartoon here for a second. So, I mean, of course, it feels great when you're the individual that holds this asset that's going up in price, right? That's kind of what you want, right? You hold an equity, you hold the all share index, or you hold the S&P 500 or the MSCI World, and the price goes up. That's exactly what you wanted. And then the joke is, what else do I need to know? Well, you need to know a lot more. There's a lot more going on below the surface, and that's what I'm trying to describe to you here. And one other example is another way of looking at equity valuation. So here I'm looking at the price of the S&P 500 relative to the hours that it would take of the average US non-supervisory worker to buy the S&P 500. So another valuation measure, but it starts to help us link the price of an asset relative to actual, real individuals' wages. And what you can see is it's expensive. So as I've said, if you're holding that asset from 1990 and you experience the increase in price, well, that's wonderful. The prices have appreciated, your investments are looking great. But what if you're trying to buy the asset now? What if you didn't hold that asset and now you want to save and invest for your future? Well, it's expensive. So there's a big inequality component to these policies that have inflated assets, and certain people have experienced that asset inflation and other people haven't. Now, listen, I'm not making the point here that there's some sort of, nefarious desire to cause inequality, but I think what policymakers, once again, made the point, they're just ignoring what the consequences are. And for me, it's increasingly obvious that inequality is a major consequence of these very unsound policies. And it's no surprise to me that society is at it's people are frustrated that people are dealing with numerous challenges and they're struggling to know exactly how to articulate some of these problems, because as you can see, some of these relationships can be a little bit difficult to grasp. Hopefully, giving you the real examples makes it easier for you to grasp. But it is a challenge. So we're dealing with this very unsound monetary system with huge consequences on our economic prospects, on our investment return potential, our ability to save for our future. It has consequences on inequality in society, which is a major problem and has been for many years, and I think will continue to be so. And just one last example here is looking at the generational impact of this inequality. So here, I'm looking at, different generations in America. Millennials are the people born, obviously most recently post the 1980s. Gen Xers born between 1965 and 1980, and baby boomers born between 1946 and 1904. And what you look at in the graph, holdings of American national wealth by millennials today, so they hold about 5% of US national wealth, relative to how much of the other generations held of US wealth at a comparable age. So you're comparing like with like. So millennials hold this 5%. Baby boomers at a comparable age held 25% of US wealth. That's absolutely astounding inequality that people often don't speak about. You see all sorts of other descriptors of inequality, but very rarely do we talk about the generational one. And this one is so obvious and so egregious that it can't be caused by any, it can't be due to skill levels. There's no way that over this period of time that these generations became, 5 times different in their skill levels and their ability to actually earn wealth. It's got to do with the financial conditions under which these generations have experienced life. Your baby boomers were buying assets when they were much cheaper. And once again, I'm not making the point that I've got nothing against baby boomers. It's just making the point that these very peculiar financial conditions in which we find ourselves have consequences that we need to be aware of. And of course, politicians aren't going to solve this problem. And actually, in fact, everywhere you look around the world, politicians just want to do more on unsound money. The only solution that they seem to want to offer is lower interest rates and more debt as the proposed solution to all of our challenges. And I'm just kind of making the point here that this is a non-partisan comment. Here we're looking at debt to GDP in the US and the UK, which are two countries with two-party political systems, where supposedly one of each of those parties is one party in each country is, assumed to be more fiscally conservative. But what the data tells you is that whether it's, conservatives or Labour in the UK or Democrats or Republicans in the US, governments go with the sign of the times. and they ramp up debt levels when it suits them. So the point that I'm making here is that politicians aren't even speaking about this problem. I mean, debt and interest rates is not even a topic for debate in presidential elections. And what they're going to say is they're going to try and solve the underlying consequences, right? They're going to try and solve inequality. They're going to try and solve low growth. They're going to try and make it easier for us to save and buy houses. But all of their solutions are going to be fuel to the fire, because they're going to do more low interest rates and more debt creation, because that is the only game that they know, the only avenue they're happy to walk down. Just going to pause there for a short second. Were there any questions on the chat? Great. Well, good to see people introducing themselves. If there's anybody new who joined late, please feel free to say who you are and where you're from. So what are we looking at here? So I said, we're living in that unsound world. I think it's quite clear how unsound it is. Hopefully you're getting an idea now of the consequences of that unsound world on our future prospects, on our ability to save and invest for our future, on things like inequality, and as a result on social frustrations that we often see in the news today. So what's the solution here? So for me, I mean, the solution is a sound money solution, a place to store value, invest for our future, and protect our wealth. And of course, I mean, our minds immediately jump towards, money as wealth. But I think it also is important just to note that there is it's a lot more than that, as hopefully you can see from the consequences, that we are trying to invest in also good ideas and good principles on which to construct relationships, communities, and society. And what is if unsound money is a money that can be created very easily, sound money is a money that can't be. It's difficult to create. And for thousands of years, as I mentioned earlier, gold was that commodity. And I wanted to just take a moment to describe to you just why, just so that we can properly get our heads around it. Often people think about gold as this mystical metal that the people who hold gold are these old men under green lights in a corner room counting their coins, and that's absolute nonsense. There's specific reasons why gold was chosen as a store of value. As we said, it's scarce, it's difficult to find, it's difficult to mine, it is durable, and as a result, it doesn't make sense to use gold for everyday purposes. I don't use gold to make a laptop or to make a cell phone. You could do it for that, but the technology of the phone, of the laptop, would get old over a period of time, and then you'd want to get the gold out of that thing. So it doesn't make sense. You rather use gold for ornamental things, which will last through generations, that you'll want to keep through generations, and it'll store wealth in it. And a nice way to see that from a data perspective is what we call the stock to flow ratio. And now we can compare gold to other assets. So gold, because we don't consume gold, it has a very high stock in the world, and the flow is quite small, right? Because we're adding to the new gold stock every year. We've got these, $10 trillion approximately of gold above the earth. And then each year we're only adding to the stock a very little bit. So the stock to flow is large, which is in stark contrast, of course, to all other commodities. We eat wheat, we eat corn. We don't store value in these things. It doesn't make sense. They'll perish. We use copper, we burn crude oil. Once again, you could store some money in crude, but it doesn't make sense. It takes up space. It can also perish. It's difficult to transport, and it's expensive. So it doesn't make sense to store your value in other commodities, whereas gold has these very specific qualities which make it a good store of value. And it's also interesting how silver fits in the middle of the spectrum, where, sorry, I'm just trying to let in a participant here. how silver sits in the middle of the spectrum, with a reasonably high stock to flow. And it makes sense then why people see it as the kind of the poor man's gold, because it has some of the monetary characteristics of gold, where it's also quite scarce. So it doesn't make sense to use, also doesn't make sense to use silver for a laptop or a cell phone, but you might use it for some day-to-day usages, for earrings, for crockery and cutlery. So it serves as that, in between. It's not as good a store of value as gold, but it's certainly a lot better store of value than, copper and crude and corn and wheat. So hopefully you can now start to understand that there are specific qualities of a certain asset, where it has a high stock to low flow, that make it useful as a store of value, a place that you actually just hold your value in it, where you're not expecting that asset to do anything in particular. You're just expecting it to hold value over time. And if you look at the performance of this asset over time, it displays that characteristic. So the yellow line or mustard line is gold in, and it's in real prices. So it's been, I've taken, CPI has been taken away from that. So the real price of gold since 1972, and it's volatile, of course, but you can see that it it increases over time, which is in stark contrast to the value of dollars, right? So dollars is the red line. It's $100 in 1972, also deflated by CPI. And you can see, of course, that $100 in 1972 is now worth an absolute fraction of what it was then, right? Because we have inflation. Um, People can also look to store their value in all sorts of assets. Some people use, houses as a store of value, and you can see their, real house prices. They have increased over time. A bit more volatility, of course, than dollars, than actual money, but certainly better performance. And it's quite interesting if you look at people in around you today. Many people actually use their bank accounts as a bank. I mean, sorry, they use their properties as a bank account. They kind of go into the overdraft facility, in and out of it when they need new capital, because they know inherently that property is a better place to store your value than it is in cash. You don't sit with a lot of capital in cash. Um, so anyway, just interesting to get our heads around that. But the broader point that I was making is that gold is a good store of value. Yes, volatile, but it has actually held incredible value over long periods of time, as well actually as equities, which is something that people often don't appreciate. And here, so the blue line is the S&P 500, also in real prices. They're all in real prices. But anyway, just confirming the point that gold stores value over time. Why? Because of these store of value qualities, because it has a high stock to flow ratio. And this concept of store of value and stock to flow is just a very badly misunderstood. So hopefully now you've got a good insight into that. And in the conditions that we are in the world today, with low interest rates, high debt, expensive valuations on traditional assets, this is an opportunity to invest in store of value assets. That's what my research shows me, right? That when you have these conditions, that's the time when gold performs well. And so, I mean, we've now entered into a gold bull market in 2020, and I do expect this to, continue over the coming years. And I'm just here showing you the four gold bull markets that we've had since the 1970s, and that they tend to, either be much longer, but certainly be much higher in price than what we've experienced in the current bull market since 2016. Anyway, I'm not, as I said, I'm not providing investment advice here. It's just to contextualize to you that when you're in this world of very unsound money, low interest rates, high debt, and weak investment return potential, that these store of value assets, that's when they particularly do well. And that's, I guess, the upside volatility in this chart that I've shown you previously. And now that we've got that understanding of store of value stock to flow, I think that's a really good angle into understanding Bitcoin, which of course is a very complex idea because it has so many ways to get at it. But I mean, this for me is obviously my background, my interest, and now that you understand, as I said, that store of value and stock to flow, you can see why Bitcoin functions as that, because Bitcoin is essentially the store of value for the digital age. So gold was the store of value for thousands of years because of its high stock to flow, and Bitcoin, I think, is the store of value for the digital age for its high stock to flow. And I'm going to get into a little bit more details of explaining to you what Bitcoin is, but just sticking with the stock to flow and store of value theme, what I'm showing you here is that same previous chart of the stock to flows of silver and gold and the silver and gold colors, and then the stock to flow of Bitcoin. And last month in December, Bitcoin stock to flow was about 40, and Bitcoin has this incredible aspect to it where it only has 21 million, so only every 21 million will be produced, but also every 4 years the supply growth gets cut in half. So if the supply growth is getting cut in half, that means your stock to flow ratio is increasing over time. So in 2024, Bitcoin's stock to flow ratio will surpass gold's. It will be a scarcer monetary asset than gold's. So it clearly is competing with gold. I mean, I think it is a superior technology for many different reasons, which we can get into, in the Q&A. But just making the point here, right, that we've looked at unsound money, all the challenges it provides, sound money and the solution that it can provide. We understand gold and the stock to flow and the reason why high stock to flow can store value over time. And now Bitcoin is this new digital asset which has a higher stock to flow, or will have a higher stock to flow than gold's. And its ability to store value as a result is incredible. And that's what we've kind of experienced over the last few years. Once again, obviously volatility to contend with, and we'll go into that detail as well, I'm sure, in the Q&A. But it is storing value because it is a scarce digital asset. And just touching on that for a little bit longer is, I mean, Bitcoin is actually a lot more than an investment opportunity, and it's a lot more than just its high stock to flow, because what Bitcoin created is digital scarcity. And if you just dwell on that for a second, that is a phenomenal creation or invention. Before Bitcoin was created, there was no such thing as digital scarcity. I can take a picture of us, all our pictures on this chat, and I can send it to us. I can send it to 1,000 people. I can send it to 1,000,000 people. You can create digital abundance very, very easily. You can create abundance very easily in the digital world. Until Bitcoin came along. What Bitcoin allows us to do is to actually have a scarce piece of a digital ledger. And that's an absolutely phenomenal invention. As I said, that digital scarcity never existed. And more and more, what digital tech companies are doing is they're trying to almost create a world of abundance. Abundance of smartphones, abundance of information, abundance of online shopping. You can get stuff delivered to your home next day. There's all this abundance, this world of abundance, where Bitcoin is this. It's in the digital realm, but it's a digital scarce asset, which is absolutely like phenomenal. Every time that I say this, it kind of dawns on me again just how phenomenal that is, that to actually have created a scarce digital asset. So, seen through that perspective, Bitcoin is a lot more than just a store of value. It's potentially a digital revolution that is, comparable to the invention of the, spinning wheel in the United Kingdom during the Industrial Revolution, or comparable to the creation of the internet in the 1980s and 1990s, which has changed the face of commerce as we know it. And for many years we obviously had this internet, and it's changed so much of how we interact with each other. But never before did we have a way to actually do commerce on the internet without using the same old technologies that we were using before. Every time you want to buy something on the internet, you have to send an instruction to your bank to send money to the other person. You can't actually do it natively on the internet, whereas that's what Bitcoin allows us to do. It's a money that is completely native to the internet. So incredible potential in this increasing world of digital information and communication. And I love this quote from Andreas Antonopoulos. Often people talk about Bitcoin as the money of the internet, which is true, but he says Bitcoin isn't the money of the internet, it's the internet of money. So the way that the internet came along and distributed and disrupted and decentralized information, Bitcoin is doing the same thing to money. So the internet distributed and decentralized information, the post office, these type of institutions are much less important today than they were, 10, 20 years ago. And Bitcoin is coming along and disrupting and distributing money, which is an incredibly exciting prospect. And I mean, I've touched on these digital networks, but it's incredible just to note the amount of value that those digital networks have been able to extract in such a short period of time. I mean, 20 years ago, most of these companies didn't exist. And what are they? They're digital networks, right? The electronics network is Apple. The shopping network is Amazon. Your internet network is Google. Your social network or digitally is Facebook. And in a very short period of time, due to network effects, these companies have been able to make themselves very valuable. And there's a strong potential that Bitcoin can do the same thing for money. So seen through that lens, there's a huge potential for what Bitcoin can do for us, and obviously do from an investment return perspective. And I've got a whole long set of valuation measures, which I'm happy to go into in the Q&A. But I mean, just one of them is using this framework of thinking of how cheap how small the Bitcoin network is relative to these other digital networks and how big it could grow. So if Bitcoin were to grow in market capitalization to the size of these other digital networks, these are the type of prices that it could go to. And as you'll see when we go through the valuation measures, they're all a little bit rough, and it's you need to navigate that uncertainty. But there's a lot of potential price upside, is basically what I'm saying here, and this one indication of that. And of course, money is orders of magnitude more important than these networks. Plus, it's also truly global. I mean, money is far more important than electronics, and of course, the electronics network, Apple is still constrained in some shape or form in its ability to operate in certain countries, whereas Bitcoin has absolutely no constraints because it is fully native to the internet. And I mean, just to say, yeah, I do. I mean, as I said, it's not investment advice here. I'm not, giving exact price targets, but I would be surprised if Bitcoin didn't, double by orders of magnitude still in 2021. There's obviously going to be volatility in this year and probably even more so next year, but these monetizations of this incredible scarce digital asset suggest that the return potential is the most asymmetric, return opportunity in the world today. And just a very brief appreciation of what it can do from a portfolio perspective. This is just comparing a basic global 60-40 portfolio on the left-hand side, looking at your annualized returns since 2010. So 6.1% annualized returns on a basic 60-40 portfolio. And then I've also put in the standard deviation of returns and the drawdowns, and then comparing that portfolio with just 1% in Bitcoin. So very small a percentage. It is rebalanced, of course, so just take that into account. But I mean, increase the returns on this portfolio by almost 2.5% over annually, with very little impact on your standard deviation returns and your drawdown. So just to highlight the from an investment return potential, the type of impact that this asset can have. But I mean, listen, to me, that's just a very small slice of kind of what we're talking about here. So just to kind of summarize for me, unsound money, I think, is systemic in the world that we are living in today. I mean, we've seen this for many years, but I mean, 2020 was just the most egregious increase in government debt. And sure, there's of course reasons why governments have done that, but the way that politicians have gone about this without any appreciation of what the consequences are and how some of that money is flooded to all sorts of corrupt entities in many different countries. This is not a South African or US thing. You can look at any country around the world, and a lot of that money is flooded into areas that we wouldn't want it to go. And why is that the case? Well, because I mean, governments are in control of it. And as I said, there are consequences to what they're doing on our economic prospects, on our investment outlook, on inequality, amongst many others, which I'm happy to talk to you about. And I think that this concept of store of value and sound money is badly misunderstood. And what we're seeing here is a revolution in money with an asymmetric investment opportunity. Basically, I'm just providing this information and encouraging people to invest their time, their capital, but more importantly, invest their time into understanding these concepts. Because it's through really understanding them that one is actually able to really benefit from them. So I'm going to leave it there. I've obviously got a list of additional resources for people to look at, and I'm also going to just kind of leave up the slide as we go into the Q&A, because obviously people have a lot of criticisms of Bitcoin, so I wanted to kind of meet those up front. And these are 10 criticisms which you might have, but happy to have any criticism when we can chat about them, and that helps us to get into a little bit more detail of understanding what's going on here, what are the risks. It's a step in the process. So I'll pause there and see how we've got any questions. Dave, hi.
Hi, Rob. How are you?
I'm good. How are you doing?
Yeah, great. Thanks. Good to see you. And thanks for the excellent discussion. I thought you really grounded it very well in the theory and the technology and made it very practical to understand. So thank you. I just wanted to pick up on something that we actually discussed in one of our CRA videos where I interviewed you a few months ago, and that is on the issue of inflation. And one of the things you pointed out was that inflation is, because one of the common themes, particularly amongst the modern monetary theorists, is that you can have this vast amounts of stimulus, but that it doesn't actually result in inflation effects in the same way it has historically. But you said that we, and you can maybe pick up on this, have a bit of a limited understanding of how inflation really works, and there's also other kinds of inflation, like asset inflation, as you alluded to in your presentation. Could you comment on that a bit, please?
Yeah, sure. Thanks, Dave. So university economics teaches us that inflation is just CPI inflation, consumer price inflation, right? And that's only half the truth. There's lots of different types of inflation, and when central banks and authorities create an unsound monetary system like the one that we're living in today, with low interest rates and an easy way to create new debt that creates lots of new money, that money must find expression somewhere in the economy. It can find expression in consumer prices, but remember also it can find expression in all sorts of different types of consumer prices. It could find expression in food, it could find expression in education, could find expression in rentals. It can also find expression in assets, houses, equity, these type of things. And what we've seen over the last 20, 30 years is that a huge creation of money, which is what I've shown you in the presentation, and I've brought back up the M1 chart here from the US just to show you how much money is being created, and that has found expression. It just hasn't shown up in the CPI basket, because remember, the CPI basket measures all sorts of goods and services all the way across the economy. Some of the things in going to this consumer price basket are things like, TVs, where the prices are going dramatically lower because of the incredible, distribution networks and technology growth of these big tech companies over the last, 10, 20 years. So on net, it doesn't look like there's much inflation, but I mean, the parents here will tell me, well, what's education inflation running at? And what's the inflation like of the assets that you want to buy? Things like property, things like equity that you want to buy to save for your future, or you want to buy to save for that education, which is also going up in price. Those prices are going up dramatically. So it's a bit of a misnomer to focus purely on consumer price inflation. And in fact, this is central to the problem. So because central banks just focus on consumer price inflation, they say, okay, well, we can kind of do whatever we want. We can create lots of new money because there aren't any consequences. And hopefully what I've shown you here is that there are numerous consequences to what they're doing. That it doesn't have to just show up in consumer price inflation. There's actually a lot of inflation out there in the economy today. It's having huge amounts of impact on our livelihoods. It's just being disguised from the CPI basket.
Thanks a lot, Rob. And if you don't mind, I'll post the link to that video that we did.
Please,
when anyone's interested, in the chat.
I think Craig, you had a question.
Yeah, thanks, Rob. Firstly, I just want to say I think it's really awesome and valuable that you spent the majority of the presentation focusing on like the underlying economics, because I think that's a point that a lot of people miss when it comes to cryptocurrency and Bitcoin in general. I have sort of a two-part question for you, and I'm eager to hear your thoughts on both. The first part being sort of that what your thoughts on the latest bull market being a result of institutional investors sort of pouring into Bitcoin as an inflationary hedge because of sort of everything that's been going on with the pandemic, and central banks just sort of essentially printing money to try and solve the problems, like you said, on a short term. And then the second part of that question is, I'm curious on what your thoughts are on how sort of people like you and me, like retail investors, are going to be impacted by the likely regulation and tax implications of Bitcoin, purely because it's something that governments can't control. So they may look to put regulations in place that prevent people sort of from having access to it.
Great, thanks for the questions there, Craig. So on the first one, the institutional involvement in Bitcoin. So I mean, what I would say is that Bitcoin is basically it's on a monetization trajectory where it started in 2009, where there was a couple of people on a mailing list playing around with this new technology, and it's grown today to a network of $500 billion, more than that now. And what that process is, as I said, it's actually a process of monetization where more and more people are adopting Bitcoin in some way, shape, or form. They might start with, $100 Rand, $100, and they might, as they incrementally understand this technology, understand the positive impact that it could have, they might, adopt more and more of it, and they start to adopt it as this monetary technology. And some people have fully adopted it as a monetary technology where they store all of their value in Bitcoin because they think it is such a superior technology to many others. Basically what I'm saying is that there's a continuum of people there, and that monetization process, eventually does, leak out into all areas of the economy. As I've said, it started on a mailing list, which is a small, group of people, and it slowly has leaked out into other communities, to tech communities, to, free market loving communities, to the investment community. And I mean, for many years, it was difficult to buy Bitcoin. You had to go through, complex ways to get hold of it. But as the monetization and adoption grows, the financial infrastructure on top of Bitcoin grows too. The technology below the surface doesn't change a lot, but the ability to use it increases a lot because companies build all of these platforms on top of it. And so that makes it easier for retail investors to use it. It also increasingly starts to make it easier for institutional investors to use it. And I mean, what Craig is alluding to is that in 2020, before 2020, there was almost no institutional investment. And of course, there's always going to be some, but we're summarizing here. There was almost no institutional investment. Why? Well, a lot of, there's a lot of credibility risk that people run by, doing things like this, holding these type of presentations. I mean, over time, less credibility risk, but as institutions, they obviously are cognizant of their credibility. And then there's the actual way that you access the asset. How do you store it? How do you keep it safe? There are complexities to this process, but as I've said, that there are now ways that are being created that make it easier for institutions. So we're seeing more institutional involvement, much bigger players. I mean, a guy like MicroStrategy's CEO Michael Saylor. He's allocated, almost half a billion dollars into Bitcoin of their own company treasury balance sheet. He said, "Listen, I've got all these dollars. I've got $500 million. Where am I going to put it into? I can't keep it in cash, given it's being devalued. Can I put it into equity, property, gold?" And he actually decided that he was going to allocate this into Bitcoin. Anyway, long story there, but we are seeing increasing institutional involvement, which will change the market somewhat. Of course, it's going to get slightly more sophisticated. There's probably going to be less volatility, and that's already kind of what we've seen in 2020. The last 6 months of 2020 is that as the price dips, you very quickly start to see people purchasing again, because I mean if once people understand the value that this asset could have, they start to ask themselves, cheapers, I don't hold enough of this. And so they see opportunities to buy more. So when the price goes down, they buy more. And so with institutional involvement, we might see more of that. We probably will see less volatility. And so, I mean, how does that impact the retail investor? Well, it's just to be aware that there's going to be more sophisticated players in the market. The days of very illiquid markets with very easy kind of trading opportunities. Some people like to trade Bitcoin. Well, those are probably starting to erode. But listen, I mean, it still is a small market. So once again, we're on that continuum. It doesn't mean that on day one now all the opportunities have gone. It's just becoming more liquid, more institutionalized. So over time, those very obvious opportunities diminish. And listen, the same thing can be said just of Bitcoin itself. As it gets adopted, the future return possibility does diminish. I mean, I still think the return possibility is absolutely astronomical, but it's lower than it was, of course, in 2010 or 2014 or 2016. Each cycle that we go in, the upside does get reduced somewhat, and I mean, once again, the experience bears that out. But I mean, I've said we're on this continuum. I think while institutions are obviously changing the market, it also is important to bear in mind that we're still also so early, because I mean, yes, Michael Saylor is allocating all of his treasury balance sheet to it, but most institutions, when they're coming into Bitcoin, they're looking at getting 1% or 2% of their assets to Bitcoin. It's a very small amount, and still these companies are at the fringe. So there is still a long, way to go before, big institutional asset allocators are comfortable with Bitcoin. And then on the second point about KYC and just regulations in general. So, I mean, maybe even to pull the lens back even a little bit on this question. I know, Craig, you probably have, you understand some of these things quite well, but just for those who, are less au fait with Bitcoin, often what you hear from people is almost the more extreme questions of, well, isn't government going to come along and just kind of ban Bitcoin? Because I mean, like the previous point, regulations can be on a spectrum, right? They can go from the absolute extreme to just small tweaking regulations at the fringes, and some people are worried that government could ban Bitcoin. And I think, I mean, the first point to note is that it's important. I mean, Bitcoin is code. It's in the internet. So you can just, you can ban Bitcoin as easily as you can ban Facebook, right? People can just log into, Facebook via, a different VPN. So the idea that you can implement those type of stringent regulations is possible, but it's not going to be particularly effective. And even if a government is to do that, to implement some sort of ban on Bitcoin, it needs to be kind of a globally coordinated effort for it to actually have much impact, because otherwise people could just move from South Africa to Europe, or from America to China, to the more favorable country for regulation. And then I guess the other point to note is just what does it say when a government does ban a software? How does the world look at China due to the fact that they've banned Facebook in the past, and we see them as this authoritarian regime that is not very open to freedom. So there's a lot of different kind of components to think through here, but living in countries that are freer than China, there certainly is going to be some degree of pushback against heavy-handed legislation. So I mean, doesn't mean we are going to get regulation at all. We are going to get regulation, and what's being proposed at the moment by the US legislators is a tightening up on kind of know your client, anti-money laundering regulations. And in actual fact, I don't think these are really going to have too much impact on Bitcoin. I mean, listen, I would rather that they weren't implemented, and it's not a sure bet that they are going to be implemented yet. But even if they are to be implemented, what it would require, what it would happen is that when people are buying Bitcoin on exchanges and then they're trying to withdraw that capital, they might have to have some information of the type of accounts and the names of these accounts of where they're withdrawing the Bitcoin to. As I said, I would rather that it weren't to take place, but Bitcoin is still going to function, no matter whether these regulations get executed or not. So regulation is probably one of the big uncertainties over the coming years, but of course many of us have spent a lot of time thinking through all these different permutations, and the long and the short of it is that Bitcoin is code. It sits in the internet, and it is actually almost impossible to actually regulate. All governments can do is try and regulate the on-ramps and off-ramps in getting into Bitcoin, right? If you want to buy Bitcoin, then you have to go onto an exchange, take your rands or take your dollars and put it onto that exchange. So governments can have some control there. But if they try and get too onerous, what they're going to do is push Bitcoin into the dark and turn upstanding people into criminals, and that will, as I said, first of all, it's going to say something very negative about those governments, and it's still not going to actually work. I mean, hopefully we're going to get onto these in other questions, but it's important to note that the vast majority of Bitcoiners are, of course, not criminals. They're really trying to do very positive things for communities and societies. I'm going to pause there, but if you're interested in that, please do let me know, because I think it's a very important point to touch on. And maybe just the last one on this regulatory front is just to note that while, of course, some regulators are proposing less positive regulations, they also are a lot of Bitcoin is becoming increasingly institutionalized. There are regulators, at the SEC, in Congress, that are more positive in their take towards crypto. In South Africa too. Yes, the older regulators are not particularly positive and constructive, but the younger people are very excited about this technology. So there's a big generational component to this. And in the years to come, these older regulators aren't going to be with us, right? If you look at the age of, US politicians today, Trump, Biden, all of their ilk, these guys are very old. So in the coming years, there's going to be a big kind of generational change in the political realm, particularly in Western economies, but also in developed countries. And of course, Western economies tend to lead the regulatory push. So the longer we go on with reasonably favorable regulations towards crypto and Bitcoin, the more it gets entrenched, and the more difficult it is for governments to do something more negative, less positive. So that's kind of the way that I look at those.
Thanks, Rob. That's really interesting to hear your thoughts. I'll definitely, we can continue the conversation offline, but I'd love to chat to you more about it.
Yeah, very, very keen to do that. Doug, you had a question.
Yeah, thanks, Rob. Got two. I don't know if there's time for both. We'll see. But the first one, I know this is more about sound money and not really a Bitcoin punt, but Bitcoin kind of fits into it well. But in South Africa, are there off-the-shelf products that you can get in, like from the JSE? I know very little. I use ETFs and equity stuff, but not that I'm aware of. But is there something that I could invest in that gives me exposure to Bitcoin indirectly?
Yeah, so not in South Africa yet. In South Africa, you need to go onto an exchange like Valor and Luno, send them rands, and then buy Bitcoin via the exchange. It is actually remarkably easy, but there are no listed products yet. So I'm just going to plug in my battery here. Yeah, so in the US, the listed products have been created. I think more are on the way. But yeah, in South Africa, they have not been created yet. We're still waiting for a little bit more kind of regulatory certainty in South Africa. My kind of legal counsel is they all kind of said, wait for greater clarity before taking decisions on fund management and the like, whereas the US has there's more favorable regulations. So as a result, there's a lot of products, there's a lot of funds. In South Africa, there aren't even any hedge funds that are investing into Bitcoin. If they are, it has to be at a less regulated construct, because the regulators just haven't provided the clarity yet. But yeah, if you want more information of how to interact with the exchanges, I can tell you about that. As I said, it's actually not very difficult. You can even ask my dad about it. He's on the call, and he's managed to buy some Bitcoin.
Okay. Is it time for a second question?
Yeah, go for it.
The second one, are there any kind of whales of Bitcoin, that guys that are maybe 4 or 5 guys that are holding a huge percentage that could influence the price and things like that? Or can you see how spread it is over individuals or not?
Yes, I don't have that. I don't have the data in the presentation. I'll try and get it and send it to you. So I mean, listen, they are big holders of Bitcoin, and sure, they can have some influence on the price. But listen, it's not so concentrated as it would be in some like some small cap share where the owners hold like 30-40% of the share count. I mean, that's not the case, right? You don't see Bitcoin holders holding you know like high middle single digits holdings of Bitcoin. So yes, there are guys who have large concentrated exposure. I mean, first important to note is that they're going to act in their own self-interest, right? They don't have any. They might know a lot about Bitcoin, but they're not. Yeah, they're going to act in their own self-interest. They don't have any. I don't think like any kind of nefarious intention, and they don't know anything about Bitcoin that's not kind of available in the public knowledge. Everybody's got access to the same data, so it's not like some company owner who actually knows the revenues, knows the problem, or some conversation that they've had with regulators. There's nothing of that in the Bitcoin market. So, yes, these whales can move the price for sure, but they are self-interested, and everybody gets access to that information anyway, including when the whales are doing something. Then the information gets posted on the it's available to everybody to see on the blockchain, and generally gets posted on Twitter very, very quickly. And I said, even still, the major driver of the Bitcoin market is the scarcity of the asset and new interest in it. It's not like once again, it's not like some small, like for instance, these other cryptocurrencies, which there are thousands of. Some of these things are incredibly low liquidity, where one holder can drive the price and conduct pump and dump schemes. I mean, that is not the case with Bitcoin. It is now a $500 billion asset. And you said you've got listed companies allocating, $500 million of their treasury balance sheet into the asset. So, it's not something that concerns me very much.
Cool, thanks. That's reassuring. Cheers.
Pleasure. Yeah, Dave, you got another question there? And yes, anybody shout, you're welcome to put on your mic at any time, any questions. But yeah, Dave, go for it.
Yeah, thanks, Rob. If anybody else has a question, I'm conscious I'm hogging the mic here.
No, just go for it.
Cool. So just in terms of Bitcoin as a store of value, I mean, that seems to make a lot of sense given what you said. But I mean, my impression is that some of the other forms of currency, like as a medium of exchange, don't really seem to have been realized at the moment. So, it seems like they're quite high transaction costs. It's quite slow. And because Bitcoin is kind of seen as such a long-term play, and I think you alluded to this in a recent article that you wrote on your website. It's kind of like a buy and hold kind of strategy that a lot of people are taking with it. So do you see that changing at all in the medium to long term? Do you think that we would be going to the shops and buying a t-shirt with some Bitcoin, or do you think that that's not really going to be how it plays out?
Yeah, no, great question, Dave. So so maybe just once again to give a bit of background into the question that Dave's asking there. So when Bitcoin transactions are processed, there is a limited amount of data that can go through each block of transactions that's added to the blockchain every 10 minutes. And I mean, it was designed in this way to try and promote the decentralization of the network. So by limiting the amount of data in each block, it implies that many people can reasonably efficiently and effectively run nodes, which allows them to monitor the network. And as a result, you have these decentralized nodes all over the world. But they're trade-offs, right? To any design structure, there are trade-offs. So the the goal of keeping decentralization of these nodes and making it easy for people to run nodes implies that there's only so much data that can go through every 10 minutes, and that implies that only so many transactions can go through every 10 minutes. And so when the network gets full, the transactions of Bitcoin can go up. So it's just to note that there, of course, there's this trade-off between decentralization and transaction costs. And then answering specifically your question, I would basically ask, what does the world need? So when we look at how unsound the monetary system is and the ease with which central authorities can create money and the consequences that has on us, for me, it's abundantly clear that what we need is sound money. We need something that is constrained in its supply, and that is what Bitcoin provides. It provides that very constrained supply asset, and I said it in a decentralized way, because if Bitcoin was very centralized, then the architecture and the structure could change very easily. So the way I envisage Bitcoin is this incredibly scarce decentralized digital asset where, yes, maybe one day it becomes a form of transactional money, but at the moment what it is it's serving the purpose of scarcity, which is in stark contrast, of course, to the money that we have today. Remember, we looked at these characteristics earlier. So the money that we have is quite divisible, portable, and immutable, but it's not scarce. And Bitcoin adds that scarcity element into it, which implies that it is a very good place to store value, but it's not as great for transactions. But similarly to the point that I made a moment ago about the world needs sound money, transactions actually aren't a big problem in the world today. I mean, if we want to use credit cards, debit cards, cash, if you want to use SnapScan, these type of technologies are available to make transactions reasonably cheap in all sorts of different currencies. So it's the value add that Bitcoin is bringing to the market is not its cost; it's the fact that it's scarce. And in the future, it's possible that all these technologies are integrated into Bitcoin, which allow us to use very low or conduct very low transactions on Bitcoin. And some of that technology has already been integrated, things like the Lightning Network, which allow you to transact in small amounts at very low costs. But if you want to conduct transactions on the main Bitcoin blockchain, there is a limited number of transactions that can go through. And as a result, there is a cost. And as a result, it incentivizes people not to buy coffee, because your fee could be as much as the transaction itself. But as I said, this is not a challenge for me, because I think that what the world needs is a savings technology where that your money will hold value over long periods of time. And so what Bitcoin has done and the Bitcoin community has done is prioritize that quality. And that's, I said, it's a wonderful thing. So yeah, the scarcity, the store of value characteristic. And I mean, the way that we basically envisage this is to say that, maybe Bitcoin in the future, once there's greater adoption, it'll almost be like a settlement layer. So, maybe, you conduct all sorts of, transactions within your community in some sort of, centralized fashion. And at the end of the day, you settle that in Bitcoin to be like, oh, okay, this is exactly on the Bitcoin blockchain. This is how much I owe, and this is how much I owe, this is how much I own. But during the day, maybe you conduct transactions in a slightly less secure manner, in a more centralized environment. But I said, at the end of the day, you settle into sound, secure, hard money. And as long as you have a periodic settlement into that, and you know your wealth, the majority of your assets is stored in this very secure form of money, that creates great confidence that it's secure, it's being protected, that it's going to be stored over long periods of time. So yeah, different technologies here. Bitcoin focusing on the store of value component. Craig, I see you had another question there.
Yeah, and it's totally okay if we don't go into this. It's sort of probably more on the technical side. But I'm interested if you have thoughts on it. Just sort of like, obviously there's a finite number of Bitcoin that can be mined, and it's gonna get sort of exponentially more difficult. So that'll theoretically be in a long time. But what kind of impact do you think that's going to have sort of in the long term, when because obviously the strength of the network comes from the decentralized nature and the fact that you have sort of individual, I mean, in this case very rarely individual miners, but sort of miners all over the world who are unrelated to each other, adding to the decentralized nature of the network. But what happens when we start getting towards the end of the supply and the mining is no longer as profitable? Do you think we're going to see a big drop off in terms of those people that are helping secure the network? Or have you ever considered or done any reading on sort of what might happen in that scenario?
For sure, yeah. I mean, for me, I think it's just that the transaction fees will have to compensate. And once again, just to contextualize Craig's question, just as we reach all the 21 million being mined, and remember, miners get rewarded through new Bitcoin supply. That's incentivizes them to conduct their operations, but they also get paid not only in the supply but also in the transaction fees. And so basically what I think is that the transaction fees will have to grow to compensate for not being rewarded as much new supply. Also important to remember though that if as the block reward diminishes, say at one point in the future the block reward is going to only be like half a Bitcoin, but if the Bitcoin price is dramatically higher than where it is today, that can still be a substantial reward. So I mean that's an important point to note. But even once we get to that point that say the Bitcoin reward is 0.000001, I think the fee market will have to compensate, right? That people will want to pay fees to settle their money on a secure network. It will make sense. And it ties in nicely with the question that we just went through about the potentially having these different markets where, maybe on the day I'm transacting on a centralized exchange where I know that, there are some risks that I'm handing over to this centralized exchange that is allowing me to transact for cheap on a daily basis. But at the end of the day, or maybe at the end of the week, you settle into into Bitcoin and you pay those higher transaction fees to make sure your capital is secured. So I'm not too worried about that block reward reducing, and I'm also not worried about transaction fees increasing, because also what happens as soon as transaction fees increase, you see this during each Bitcoin cycle, that the solutions start to be prioritized. So there are lots of solutions afoot for high transaction fees, and then as those transaction fees they increase, then the incentive comes out for people to be like, hey, launch your solution. What can we do to solve these high transaction fees? So yeah, I expect higher transaction fees in the future to compensate miners for the lost Bitcoin block reward.
Right, and sort of like alternate solutions to just from going from legacy to SegWit to native SegWit, and I mean even with all of those advances, the transaction fees seem to be coming down.
Exactly. I mean, listen, that's one of the beautiful things about Bitcoin is that it's just this incentive network, and people respond to incentives. So, I mentioned now as the fees go up, then solutions to the highest fees come through. But one of the other solutions to the high fees is that people stop buying coffee with Bitcoin. So, or people maybe stop buying something else. the market adjusts and people like realize, okay, well, yeah, Bitcoin's not so great for buying coffee, but it's still good to store my value in it. So I'm just, I'm not going to buy coffee. I'll buy coffee with dollars. I'll buy coffee with rands. Maybe I'll buy coffee with Lightning. Maybe I'll experiment with some Lightning. Lightning works. Lightning's almost, it's free. It's not as secure, but yeah, sure. I'll just keep, $50 in Lightning. And be able to buy my coffees, and then, I'll reload my Lightning wallet, like once a month, just like people, reload their cash and their leather wallets, periodically to make sure they've got cash. So there's different ways to use this technology, but the primary purpose of Bitcoin is the store of value component. And when you're storing your value, like, even if you're not a particularly rich person, maybe all your life savings is 100,000 rand, but still, that if you're doing a transaction into 100,000 rand in Bitcoin, the transaction fees are negligible. It only becomes a high proportion of the transaction when you're doing $5 or 50 rand transactions. So it's Bitcoin serves its purpose as the store of value for just reasonably high value transactions. And yeah, for people who are very poor, I mean, somebody could almost ask the follow-up question, of course, does that mean that people who are very poor, who have no financial capital, have no use for Bitcoin? Well, I would still disagree with that, right? You could go straight into Lightning. Yes, okay, it's not as secure as on the main chain, but if you're only, if you're just starting to save whatever 50 rand a month, well, that's fine. It's not as secure as the Bitcoin main chain, but sure, it's a lot more secure than storing your 50 rand in dollars or rands, where the government can print a lot, more of it. So I think that there's solutions to all of these challenges, and as the market innovates, you see more more solutions, more financial infrastructure. I'm happy to take more questions, and also, guys, don't feel been some good detailed questions. If you have any basic questions, don't don't feel pressured not to ask the basic questions. Basic questions are sometimes the best questions. Are there any more questions? Craig, I see your hand is still up. Is that another question, or Doug?
I just saw there's one or two questions in the chat.
Thanks. I wasn't looking there. Oh, thanks, Bruno. Yeah, okay. You're right. I'd forgotten about that crypto ETF. Yeah, I mean, one also just needs to be cognizant of crypto versus Bitcoin. These are different things. So I would. It's not to say that I don't think that there's value in other cryptos. I mean, I think there is, but I do think that the primary challenge that we have in the world today is unsound money, and what Bitcoin provides is sound money. And so I do recommend for new entrants to be primarily focused on Bitcoin rather than the other cryptocurrencies. I mean, another way to look at that is that, of course, you're investing. If you do decide to make ever these investments of your own accord and doing your own research, I mean, of course, you're investing into something that's quite volatile. And the way I see it is trying to also invest almost in the least volatile, the least risky one, which of course is Bitcoin. But I'll pause there. But let me know if anybody has any more questions about Bitcoin versus crypto, because I think that is it's a very interesting topic of conversation. Yeah, so I mean, Bruno's asking here about scaling. I mean, we've kind of touched on it in the previous points that there are scaling, solutions. There are ways to get around this, plugging in, plugging in centralized technologies. Things like, exchanges themselves function as centralized technologies. So, people who all are on one, South African exchange, say Luno, or on Coinbase, they can do transactions with each other at very low costs. There are, of course, risks to this, but it does solve some of the scaling solution. And then, of course, there are things like Lightning. There are second layer solutions which will reduce transaction costs, transaction fees. I see, Bruno, you also asked if you want to come on and chat, you're more than welcome to do so. You also asked about governments coming down from the regulation perspective. I mean, I agree with you. Listen, regulation is coming. We do need to be aware of it. But yeah, I think, I have contextualized that question quite well, is that, there's this continuum of different ways that regulation could be executed. The lighter touch stuff, as I said, it won't have much of an impact. And even the heavy touch stuff, it's not to say that it won't have an impact. Like, if government came out and banned Bitcoin tomorrow, that of course will stop a lot of people from using it. But I mean, I tell you what, people who really need Bitcoin, they're not going to stop using it. People in Venezuela, in Argentina, in Afghanistan, where the financial system is completely and utterly corrupt, where they experience high rates of inflation, where there's huge amounts of discrimination. These people see Bitcoin as freedom, as liberty. Recently in Nigeria, where there was those protests against the government, women were taking Bitcoin donations. And it was only because of the financial network provided by Bitcoin that allowed them to take that donation and to fight back against the oppression of the government. In Afghanistan, we've got, ladies who are able to, learn coding and work online and earn money in Bitcoin. They wouldn't be allowed to conduct business in Afghanistan otherwise, because of the patriarchal society that they live in. And of course, in a place like Venezuela with hyperinflation, people are using Bitcoin to stay alive and to order food from around the world. And while you can make the argument that, of course, most people on this call don't live in that type of regime, I think it's we first of all need to be aware of the risk that things deteriorate. But second of all, just remember that just because you're not in that situation doesn't mean there isn't a use for Bitcoin. Yes, you're on the spectrum. So maybe Venezuela's down here at the far end of the spectrum, and Afghanistan and Argentina are just next to it. And maybe maybe if you're living in Singapore, you have much less use for Bitcoin. But everybody's on the spectrum with some sort of government corruption taking place of their money, of their society, and there is a liberty that Bitcoin affords people. And yeah, so even if there's very heavy-handed legislation, there's ways around this, and there are there are many people that are still going to be willing to take that on.
I have another question if no one else is immediately pending. Rob, how do you feel? I mean, just given that you're in the US as well with Bitcoin specifically, but I mean, this is also just in general to digital assets, is sort of taxation and the IRS and the complexities that come with that around the time of submitting tax returns, and just given that sort of like every, even, let's think the right words, sort of even changing one cryptocurrency to another technically counts as a transaction, so as a taxable event. Just like, what are your thoughts on tracking that, and then sort of just like reporting and like just the general complexities surrounding taxation? I mean, relative to here, the US, but I mean, I guess also everywhere, South Africa included.
Yeah, I mean, I think for me, it's the regulation promotes long-term holding. not too much trading, which is a good thing. So yeah, I mean, I would just recommend that most people do that long-term, holding and not trading and not buying, Bitcoin with small transactions. And if people are doing that, then it makes sense to, if you are doing things with small transactions, then it makes sense to try and find ways that, those transactions are not easily obvious, so that you don't have to report each, R5, $5 that you're spending, because I wouldn't want to go through that process. But yeah, if you're deciding to sell out of a large amount of your holding because you're taking profits, or you're buying something else that you really want, well then yeah, you just go through the process of reporting it. I mean, from that respect, then if you're just doing it once a year, then I don't think it's particularly onerous. And yeah, listen, as soon as you're making big transfers in and out of your bank, you obviously need to know that you need to take your precautions and report that to the authorities. So yeah, so I would just recommend people don't do a lot of trading. If they are, I mean, I don't do a lot of short-term trading, so I don't use any of those products, but they are products that do exist that now will allow people to track and help them with their filing. So I mean, if people are interested in that, I have to look them up and find exactly the ones. But yeah, if you're trading a lot, there are. I mean, because this stuff is all digital, in actual fact, if you have the technology, it's going to be quite easy to track. But yeah, most people, I think it's just to stick to long-term holding, and then you're not paying any tax until you finally decide to take the capital gains hit when you do withdraw into your bank account. Bruno, on the whales, yeah. So I'll look at this data again. But I think important point. So right, yeah, these whales hold a lot of Bitcoin supply, but I mean, there are lots of different whales out there. It's not like these whales are all coordinated with each other, and they're all kind of texting in some WhatsApp group to to influence the Bitcoin price. So yeah, I mean, listen, as I've said, I mean, whales can change the price, but it's not like, it's certainly not like, Bitcoin is a pump and dump scheme that, okay, now whale has sold, now the price is dramatically moving in the other direction. And as I said, the data is publicly available. So I mean, one of the indicators that I would use in the market is looking at things like the length of time that wallets haven't been touched. That suggests to you that there's a lot of it's like stability, a lack of desire to sell those funds. As you see those start changing, then that's an indicator that the market is becoming a little bit more frothy. But as I said, that data is freely available to people. That's doing market analysis, just like you would do market analysis on any financial instrument or asset. So yeah, it doesn't concern me a lot. You see, many other assets that are far more concentrated than Bitcoin is. Yeah, I mean, a short answer to your question there, Bruno. I think that Bitcoin is the I mean, it's the soundest asset in the world has ever seen. Well, it will be at some point. And those whales, as I said, while they can sell their coins and they can move the price, they are self-interested. There's a reason why they've held for a long period of time. And what you see actually over time is that centralization, well, I mean, it fluctuates. So you said, I mean, it does increase over periods of time. But I think if you draw back that data over much longer periods of time, it actually is becoming less concentrated. As whales decide to sell out and buy houses and buy businesses, because they hold more than enough Bitcoin. So you can read that data in many different ways. because also the fact that they hold a lot also suggests that they're quite confident about the asset. If it was real pump and dump, would they not have just sold out earlier when the price went up in 2017 or whatever it was? So I'm not overly concerned by the whales. Most of these guys are heavily invested in the network. They provide information. A lot of them run Bitcoin businesses. I think that most of the time, obviously you can't speak for every single actor, but most of the time these people are adding a huge amount of value, and they are invested not only with their capital but their mind, intellectually, with their time, into making a success of the project. It's always good to have a skeptic, though, Bruno. Always enjoy your skepticism. Doug, have you got another question there? And Mac, you want to go first? You got your hand up.
Yes, thanks. I just wanted to, and thanks for a very insightful discussion presentation. Just in terms of kind of for people that see the opportunity that Bitcoin presents, as a store of value, and also a vehicle in the early stages through which to experience very material capital appreciation, and also just given some of the concerns that you've outlined, that we hear because of kind of unsound money practices, the take on of debt, like there's no tomorrow and those kind of things. But just given what people see in Bitcoin, and particularly people that trade it and that invest in it and that understand the opportunity, what are the risks that people might see this and actually use debt, or so go out into the markets, into the economy, get debt, and use that debt to invest in Bitcoin? And what at what point does this behavior become problematic? And and what do you see the risks? Do you see it as a problem, and what might go wrong if this practice continues to? Because it's something I've been thinking about. I've been thinking about like Bitcoin, like I see the price moving so breathtakingly, like beautifully, and I'm just thinking, well, if I have all my capital invested in it, and I have nothing else, but I believe you can still do more. Why don't I just go to the bank and just take out a big loan and just put it in there, and I'll see it later, that kind of thing.
Yeah. So, short answer to your question: there's a massive incentive to. Not saying it's the right thing to do. I'm just saying there is a big incentive to leverage your Bitcoin exposure, because essentially what you're doing there is that you're saying you're shorting whatever currency it is that you're taking that leverage in, which you can make a sound argument for that, given what central banks and authorities are doing to their money, and then you're betting on a sound of money. So yeah, in short answer to your question, there's a big incentive for people to do this. And this is just where, words of caution, of course, need to be exercised, that, do those individuals understand what it's like to trade on leverage, what the risks are, what happens when a position moves against you and you go underwater and you have margin calls, and of course, a very volatile asset. So yeah, does one actually have the experience of doing that? And that's what I say to people. I run like a Bitcoin meetup here in LA, and we're getting more and more of those questions. And listen, they're genuine questions. These aren't, I think the same thing, right? If you're so confident in this, why don't you just leverage up and go long? So, but listen, people just need to think through their own financial conditions. Are they secure? Have they got experience doing this? And are they willing to take that risk on? At the end of the day, people are going to make the decisions that they want to make for their own, based on their own conditions. And some people, of course, are going to go leverage long, and a lot of people are going to make money out of it. But just make sure that you're in the financial condition to be able to take on that risk, and that you save, you're not putting financial strain onto yourself, onto your family, onto your kids. I mean, obviously these are very important questions. So I'd dissuade people from doing it, but at the same time, I'll obviously speak through the complexities so that people just understand it, because some people are going to do it anyway. They might as well understand it. I think a better way to do it than buying like naked futures is probably buying options, because at least then your downside is limited. But as I said, I'm obviously not recommending anybody do anything in particular. That's just the way that I would think through it, is rather do it through options than with futures, because you limit the downside. Was there any other part to your question, Mac? Did I cover it?
Yeah. So I think there's almost like a philosophical, layer to the question. That these people got here because, or we got here because of unsound money, and Bitcoin has presented this opportunity. But there would be actors that would continue to sort of fuel the debt-driven world by continuing to do this, are using Bitcoin. So Bitcoin perhaps now potentially becomes mired in the whole problem to that was started to begin with.
Agreed, and it's kind of, the argument can just go in circles and circles, right? So it's important to recognize, of course, that Bitcoin is directly impacted by unsound money. I mean, Bitcoin wouldn't exist if it wasn't for unsound money. I mean, Bitcoin was created in 2009 in the depths of the financial crisis, and it's enshrined into the first the Genesis block, the FT article about the chancellor bailing out banks in 2009. So, I mean, Bitcoin is directly a response to the financial system, but at the same time, obviously it benefits as governments do more ridiculous things with our money, Bitcoin will benefit. So that's what there's always a slight truth in people's criticisms of Bitcoin. So that's why I always think it's interesting to take those questions and to understand them properly rather than just dismiss them, because obviously Bitcoin has a speculative component to it. Obviously it benefits from low interest rates and debt. To ignore that would be ridiculous. But not only does it benefit, it responds to it, and it provides us with an alternative. Hence why I'm still, obviously very constructive and very focused, and think that there's a lot more to it than just the idea of making money and some speculation. But at the same time, also, there's nothing wrong with making money. I don't think there's anything wrong with that. But individuals just need to think through the risk that they are willing to take on. And to your philosophical point about, is one who's going on leverage, are you going to being unethical by accentuating the unsoundness of the current financial system? Well, you could make that argument. I mean, other people would also say that they're accelerating the degree to which that unsound system is going to be found out. So some people would say they have a duty to do that. So as I said, everybody just needs to think through their conditions. Because at the end of the day, listen, when you're going long Bitcoin in large size, if that's the confidence that you have built in your head, you are making a very strong investment a directional bet, but also a philosophical directional bet. You're making a political bet. And you should be aware of that, of course, if you're doing this in a very concentrated way. And once you take those steps, there's all sorts of questions that come to mind, as said, including taking on leverage. And I said, you can make the arguments in both senses there, that in one sense is unethical, in another sense people would make it that that's exactly what you should be doing. So I'm not going to recommend exactly what you should do, but I'm happy to talk through the risks. Doug, did you have another question?
Yeah, sorry, my last one. Just going basics to the exchanges. If you buy a Bitcoin from one exchange, like let's
Yeah.
say use Luna here, can it be transferred to another exchange like Vala or somewhere else international? I'm just asking because like that, I'm not sure the details, but an MTI company that went belly up and people were buying kind of Bitcoin through them or something, and they collapsed. Are your investments still secure because it's a separate Bitcoin token, or is it within Luno that I'm buying and then Luno has Bitcoin?
Yeah, great question. Thanks for that, Doug. So very important when you're buying Bitcoin that you go to the right place. There's a whole spectrum of ways to access Bitcoin. Going from buying Bitcoin and taking it off that exchange and storing it yourself in self custody so that you are your own bank, versus going onto the exchange and keeping it there. And some people, I mean, I certainly get Craig saying never store your Bitcoin on exchange, and I concur with that. But listen, if you're just stepping your toes into the water and you're buying a small amount of Bitcoin, maybe the self custody is the next step that you go through. I don't think you necessarily need self custody on day one if you're going to a reputable exchange. And there are reputable exchanges out there, but so just getting back to the spectrum, right? So there's buying and self-custodying, there's buying and holding on the exchange, and then there's buying at not reputable exchanges that, I mean, do they even have the Bitcoin? Well, that's an important question to ask. And then there's like financial products that kind of say that they give you exposure to Bitcoin, where you never actually have the Bitcoin. So these are very critical questions to go to. To answer, you must always choose to go to an exchange that actually has the Bitcoin and actually allows you to withdraw the Bitcoin, right? If the exchange doesn't allow you to withdraw the Bitcoin, then you should never, ever, ever go there, because you should always be allowed to self-custody. If the institution does not allow you to self-custody, and when I say self-custody, just to repeat, that means taking your Bitcoin onto your own wallet, whether it be a paper wallet, a cell phone wallet, a hard wallet, whatever, but it's in your own possession. It's no longer the responsibility of the exchange. As I said, there are risks in doing that, but it allows you to fully express being a Bitcoiner because you're fully able to be your bank. So to reiterate, never go somewhere where you aren't allowed to withdraw your Bitcoin. For example, in the US, there's some like Robinhood accounts, which are equity trading accounts. At the moment, they don't allow you to withdraw your Bitcoin. I wouldn't recommend people go there because then you can never actually fully express holding Bitcoin. You only ever get exposure. And I don't know the details of the example you're giving, Doug, but that sounds like an example where there was, some shady activity going on. Where you weren't actually able to withdraw your Bitcoin. So, in South Africa, Vala and Luna are pretty reputable. I mean, I've met many of the people there. The guy at Vala, I think is a really good guy. I'm not saying that you should trust the exchange, but I would trust them enough to put my money on there for some period of time. And they, of course, do allow you to withdraw. And to specifically answer your question, if you go to an exchange that does allow you to withdraw Bitcoin, that means you can send that Bitcoin wherever you want. You can send it to a wallet. Well, of course, the wallet's on the internet. So whether the wallet is physically located in South Africa or China or Greenland, it doesn't make any difference. The wallet, the information is on the internet, and you can withdraw it to your wallet or your friend's wallet or your dad's wallet. That's the beauty of Bitcoin, is that once you have Bitcoin, no one can tell you where you can and can't send it, and that's very powerful.
Cool, that's reassuring. Thanks, Rob.
So yeah, I mean, listen, if you're new to Bitcoin, just always ask somebody, where should I buy my Bitcoin? There's lots of reputable places out there, but there are also lots of scams out there. Listen, this isn't a fully regulated industry. There are all sorts of fly-by-nights out there. That doesn't say anything negative about Bitcoin from my perspective. All it just tells you is that it's an exciting industry and there are people that are trying to steal your money, but just don't let them steal it. Just go to the places that are reputable. yeah, do business with them, and take the right practices, and listen. That's one of the things that I am hoping to provide here. Is I do think some community support is required in the Bitcoin industry. I find a lot of value from speaking to people. I find a lot of value from going to meetups, and I hope you do too, because you need people to walk along the journey with you. You also don't know about all these things from one presentation or 5 presentations. I'm still learning, and I think most people are too. And you also don't mitigate against all the risks on day one. As I said, that's why a step-by-step process. So, I mean, for me, the step-by-step is just getting something, a small amount. And as I said, you don't have to self-custody on day one. But at some point, when that amount of money starts to become, noteworthy, then you should certainly be considering self-custodying. You want to take away that risk from the exchange, because just to confirm, with an exchange, what the risk is that all of that Bitcoin sits in one place. So God forbid there was some nefarious action at the exchange. Maybe the owner, I don't know, maybe went through a divorce and he lost a screw in his head, and he decides to do something to steal that Bitcoin. Listen, reputable exchanges will have circuit breakers in place that don't make that type of thing very easy. If reputable exchange will obviously have security measures, that the responsibility is not in one person's hands. But I'm just describing to you that as soon as you have your money in a centralized place, you of course are delegating some trust to that institution, and things can go wrong. Whereas when you take self-custody, all the risk is on your plate. Right, so I withdraw that Bitcoin from the exchange onto my phone. Now it's my responsibility. No one's going to steal this money from me. It's very, very difficult to steal Bitcoin from somebody. But if I lose the password, then no one's going to come and help me out because I have taken the responsibility. And so that's why I'm a little bit more cautious about, Craig saying never store your Bitcoin. I think only store your Bitcoin when you're ready to just appreciate what the risk is. If you buy 100,000 Rand of Bitcoin and then you withdraw it to your wallet and then you lose the keys, well, you're going to be quite upset. So just make sure that you're ready to take that responsibility onto your plate. And listen, you should do that, but just think it through. Mac, have you got another question?
No, I'm good, man. Thanks.
Okay, nice one. Well, if there aren't any more questions, really do appreciate all the questions. Good to see everybody and hear your voices. Hiran, how are you doing there? Did you find value?
Yeah, yes, I did. I mean, sorry, I was very silent there. To be honest, I think I couldn't add anything. But yeah, no, I mean, from being a complete novice here, I've learned a lot. I've read, but while you guys were talking on your website as well. Yeah, no, I found a lot of value. Thank you very much. It's great value. Thanks a lot.
Fantastic. Well, I'll send you guys a follow-up email in the coming days. Wishing you guys all the best for the rest of the week and the weekend ahead.
Yeah. Thanks a lot, Rob. Keep up.
Cheers.